The first issue is to look at the extent of the problem, right? So today, if you look at the WTO stats, goods 19 trillion, contracting at about 7 to 8% because of COVID. Okay, you've got services 5.8 trillion, still expanding despite COVID at a rate of about 3 to 4%. You've got 10 trillion today is the demand for working capital, 30 to 120 days, of which roughly about 60% is open account and about 40% is LC today. Okay, but that definitely there's a trend growing in favor of the open account, right? Why? Because industries are consolidating. As buyers get bigger, right, they set the rules of the game and they don't have to participate in expensive bank programs. That's just the reality of it. Okay, so if you take this, the other statistic to watch is that 5 trillion goes of the 10 trillion is financed in some shape or form, which means 5 trillion goes unfinanced today, right? In India, that is 350 billion. If you look at the IFC report that was done last year, roughly 26 trillion rupees goes unfinanced. Or if at all, it's through shadow banking, right? Where rates start at 22% and then go up to 40% per annum, to Chantal's point earlier, right? And COVID has only made that worse. So you need, Chantal also made a very good point about risk, which I want to talk about. So what's happened is that in the post-COVID era, a lot of factoring and receivable finance programs have melted down. That's just the reality of it. Why? Because buyers themselves don't know when they're going to pay, right? So therefore, the only people you can take any decent risk on today is AAA, maybe AA minus anchor buyers, right? Very difficult to take any kind of risk, even if you have insurance on others, right? Look what happened to Greensill, completely unraveled, right? A multi-billion-dollar enterprise unraveled within weeks, right? Why? Risk, and risk due to exposure to steel industry, right? So all I'm saying is that there is an opportunity here, but you need to look at the problem differently. So the problem is this: there is trapped liquidity existing in the system. If you take approved payables, most programs today have sub 15% adoption by anchor buyers of those approved payable finance programs, which means 85% is trapped liquidity sitting in the system. Why? People are just waiting to get paid. You got a lot of cash-rich tier ones who don't need the finance. Interest rates have dropped, so they can get alternate finance. So this is a vicious circle, right? Which means they're not participating in programs. If they don't participate in programs, that means the tier 2 and tier 3 don't get any benefit. And 60% of suppliers today fall outside of any program. That's the real opportunity. So what we've done is we've used asset tokenization to do something very simple. Tokenize all of the assets. What needs to be funded at tier 1 level can be funded. Anything else can be pushed down as a closed loop digital credit, right? This touches upon regulation as well. The last thing you want to do today is go and butt your head against a regulatory wall, right? So therefore, it's important to find solutions that work with and around regulation rather than trying to change the regulation. At least in the short term, it's not a reality. So what we've done is we've created a digital credit that uses existing structures such as dynamic discounting and approved payable financing to extend that credit to tier 2, tier 3 and beyond through something very simple, which Pramit talked about, which was a digital wallet. A digital wallet contains a token. I can be a beneficiary of a digital credit. If I'm a tier 2 or tier 3 supplier, I can only do 3 things with it. I can request early payment, I can assign it to my further upstream supplier, or I can wait for due date, right? And so what we've done is we've tried to simplify this whole thing, right? By taking a latent opportunity in the market and ensuring that the grassroots can get access to it.